Hello guys, welcome to Golden Eye Learning. This is CMA Deepak Kumar, accounts trainer. So guys, let's just quickly go ahead with the today's video agenda. So in this video, we will cover one of the important question of cash flow statement as per accounting standard 3. So cash flow statement chapter is important from exam point of view. It mostly comes in exam. So before starting a practical questions, I am going to tell you in brief discussion of cash flow statement. So what is cash flow statement? Cash flow statement is a statement which present flow of cash and cash equivalent during specified period. Cash flow statement acts as a bridge between income statement and balance sheet by showing how money moves in and out of the business. We make cash flow statement in vertical format, whereas cash book in T format. So this is the vertical format of cash flow statement. So cash flow statement as per accounting standard 3. Particulars amount. Cash flow statement is divided among 3 activities. First is cash flow from operating activities. Second is cash flow from investing activities. Third is cash flow from financing activities. Now add all of these 3 activities. We get total cash flow from all activities. Then add opening balance of cash and cash equivalents. Then finally we get closing balance of cash and cash equivalents. And this is the T format which we use for making cash book. So what do you mean by cash and cash equivalent? Cash means cash in hand. Cash equivalent means equal to cash, like bank balance. But bank overdraft is not considered as a cash equivalent. So we will more understand this in detail. Accounting standard 3 accounts for the information about changes in cash and cash equivalent of a business entity. Such information is disclosed in the cash flow statement. So accounting standard 3 specifies how to prepare cash flow statement. It doesn't mandate its preparation. Who should prepare cash flow statement? It can be voluntarily prepared by anyone. IRDA, Insurance Regulatory Development Authority, requires all insurance company to prepare cash flow statement using direct method. Insurance companies are like LIC, MetLife, Kotak Life, Reliance, ICICI, etc. SEBI, Security Exchange Board of India, clause 32 requires all listed companies to prepare cash flow statement using indirect method. Listed companies are like Reliance, Tata, etc. Why cash flow statement is so important? It is important because it informs to readers of business its cash position. For a business to be successful, it must have sufficient cash at all times, as it needs cash to pay its expenses, to pay bank loan, to pay taxes, to purchase new assets. Cash flow statement determines whether a particular business has enough cash. So why cash flow statement is so important? It is important because it informs to readers of business its cash position. Cash flow statement determines whether a particular business has enough cash. In fact, in the business world, small businesses rarely produce cash flow statement, as profit and loss is sufficient for their needs. For large entities like Nike and Microsoft, having cash flow statement is imperative. Such companies will often have non-cash transactions. Sometimes even billions of dollars in revenues has not been received in cash. In this situation, profit and loss is not sufficient always. So cash flow statement is valuable to many users like banks and shareholders. So let's understand the cash flow statement through a small example. Now come to the example. So cash flow statement example. Let's imagine you start a business with $10,000. With that $10,000, you buy a box of ingredients and made laptop. You sell all laptop to a customer for $50,000. Customer will pay for the laptop at the end of the month. Let's determine your cash position in this scenario. In answer, revenues is $50,000. Under accounting rule, revenues is recognized when it is earned, not when it is received. Therefore, Sales must be recognized as revenue received. Profit $40,000. You spent $10,000 on the laptop and sold them for $50,000. So this leaves you with a profit of $40,000. Cash zero. Even though you have earned $50,000 in revenue and $40,000 in profit, you have zero cash. So this scenario can often play out in the business world, particularly with the large organizations, which signifies the importance of producing cash flow statement. So now cash flow statement consists of cash flow from operating activities, cash flow from financing activities, cash flow from investing activities. So before getting to know more about cash flow from operating activities, we will first understand what is cash flow from investing activities. So now come to cash flow from investing activities. When flow of cash arises from fixed assets, investment and its incidental incomes like sale or purchase of fixed assets, investment, interest income on investments. Next is cash flow from financing activities. When flow of cash arises from its capital structures like equity share capital, preference share capital, debentures, loan, bank overdraft and its services cost like issue of share capital, repayment of loan, interest paid, dividend paid. Now come to cash flow from operating activities. To find out cash flow from operating activities, we will have to eliminate the effect of non-operating expenses and non-operating incomes. So all non-operating expenses should be added to profit before tax, as due to these expenses profit would have reduced. Although these expenses should not be deducted from profit before tax. So now to nullify the effect of reduced profit, add these expenses to profit before tax. So if we talk about non-operating incomes, so these income should be deducted from profit before tax, as due to these income profit would have increased. Although these income should not be added to profit before tax. So all companies must determine its revenues and expenses on cash basis. So we will more understand this through a practical question. So now come to the question. So question number 1. X Limited presents you the following information for the year ended 31st March 2019. Rupees in lakhs. Net profit before tax provision 36,000. Dividend paid 10,202. So dividend paid is an item of financing activities, so it will be deducted from there. So next is income tax paid 5,600. So income tax paid will come at the end of operating activity and it will be deducted from there. Next is book value of assets sold 222. Loss on sale of assets 48. So both of these items will come under investing activities, but loss on sale of assets will also come under operating activity as it is a non-operating expenses, so it will be added to profit before tax. So next is depreciation debited to profit and loss account 24,000. So depreciation is also an item of non-operating expenses, so it will be added to profit before tax and it will come under operating activities. So next is capital grant receipt amortized to profit and loss account 10. So capital grant receipt is an item of non-operating income, so it will be deducted from profit before tax and it will come under operating activity. Next is book value of investment sold 33,318. Profit on sale of investment 120. So both of these items will come under investing activities, but profit on sale of investment will also come under operating activity and it will be deducted from profit before tax, as profit on sale of investment is an item of non-operating income. So next is interest income from investment credited to profit and loss account 3,000. So this is also non-operating income, so it will be deducted from profit before tax and it will come under operating activity. Next is interest expenditure debited to profit and loss account 12,000. Interest actually paid for financing activity that is 13,042. So interest from financing activity in total is 13,042. So out of this 13,042, only 12,000 will be added to profit before tax and it will come under operating activity. And the other effect of 13,042 is whole 13,042 is deducted from financing activities. Okay, so now next is increase in working capital 67,290 excluding cash and bank balance. So increase in working capital will lead to decrease in cash flow. What is the meaning of working capital? Working capital means current assets minus current liabilities. Current assets are like stock, debtor, prepaid expenses. Current liabilities are like creditors, short-term loans, outstanding liabilities. Working capital is the net current assets over current liabilities. If suppose there is increase in working capital, that means increase of stock, debtor, prepaid expenses. It means our money get fixed into it. Hence working capital increases, cash flow decreases. So this item will come under operating activity and it will be deducted from there. So next is grant received for capital project. Purchase and plant machinery 22,092. Expenditure on construction work 41,068. So expenditure on construction work is an item of investing activity. So both of these items will come under investing activities. Next is grant received for capital project 18. Long-term borrowings from banks 55,866. So both of these items will come under financing activities. Next is provision for income tax debited to profit and loss account 6,000. If suppose net profit, suppose in the question net profit after tax given, in that case we add provision for income tax to get profit before tax. But in the question net profit before tax is already given, so there is nothing to do with that item, so leave that item. Next is cash and bank balance on 1/4/2018 6,000. Cash and bank balance on 31st March 2019 7,500. You are required to prepare a cash flow statement as per Accounting Standard 3 revised. So now come to the answer. So cash flow statement as per Accounting Standard 3 revised using indirect method. So in this question we are not using direct method, as direct method is used where the details of sales, purchase, income and expenses are given. So that's why we are using indirect method. So answer is divided among three activities. First is cash flow from operating activity. Second is cash flow from investing activities. Third is cash flow from financing activities. So now we are doing cash flow from operating activity. So net profit before tax provision 36,000. Add loss on sale of assets 48. Then add depreciation 24,000. So both of these items are non-operating expenses, so that's why we are adding. Next is amortization of capital grant receipt 10. Profit on sale of investment 120. Interest income on investment 3,000. So all of these three items are non-operating income, so that's why we are deducting. Okay. Next is interest expenditure 12,000, which I already explained earlier. So this is 12,000 and now we consider here. And after adjusting all of these items from 36,000, we get 68,918 as profit before working capital change. Then deduct increase in working capital 67,290. Then after deducting we get cash profit before tax, that is 1,628. Then deduct income tax paid 5,600. Then after deducting finally we get net cash flow from operating activities, that is negative 3,972. So now come to cash flow from investing activities. Sale of assets 222. Then deduct loss on sale 48. Then after deducting we get 174. Sale of investment 33,318. Then add profit on investment 120. Then after adding we get 33,438. Then add interest income from investment 3,000. Then deduct purchase of plant and machinery 22,900. 22,092. And next is expenditure on construction work 41,688. Then after adjusting all of these items, then finally we get net cash flow from investing activity, that is negative 27,168. So now come to cash flow from financing activities. Dividend paid 10,202. Then deduct interest paid 13,042. Then add grant for capital project 18. Then add long-term borrowings 55,866. Then after adding all of these items, then we get net cash flow from financing activities, that is 32,940. Then after adding all of these three activities, that is A means operating, B means investing, and C means net cash flow from financing activities, then we get 1,500. Then add opening cash balance 6,000. Then finally we get closing cash balance, that is 7,500. So now come to the conclusion. Which company is better? Company which earned from operations and repaid loan from that money, then invest money will be better. In the given question, X Limited is, instead of earning money, it is absorbing money, although it is better company. It is assumed that X Limited is a startup company. It has raised, its cash flow would become positive gradually. It has raised money from loan and invest in the project, which is a sign of growing company. Now that is done, if you have any doubt, then please let me know in the comment section. Thank you.